A common mistake made by many investors is spending hours building their portfolio but then choosing to effectively ignore them. This can be a potentially fatal error. Not keeping a close eye on your chosen funds may have disastrous consequences for your longer-term financial health. Let's first cover why you should monitor your portfolio. For one, we want to make sure that your investments are meeting your overall objectives, as well as reminding you of what you own and where it's invested. Carrying out a regular portfolio review allows you to assess the performance of your chosen funds. So consider the following 4 questions. Has the value of your investment increased or fallen? How has the fund performed in comparison to its peers? What are the reasons behind the returns? And how much money have you made or lost? Ultimately, what was a perfectly diversified portfolio a year ago may now need some tweaking. Simply by failing to address imbalances that may occur naturally after significant price gains or falls, you could be introducing more risk into your portfolio than you're truly comfortable with. As well as scheduled reviews, you should also re-examine your portfolio positioning in light of major events, those happening in the world in general, but also those happening in your own personal life. Ask yourself, has your financial position changed? Has your attitude to risk altered? When conducting your review, you want to consider 2 major factors, your investment goals and your risk level. First, step back and re-familiarize yourself with your goals. What are they, and importantly, have they changed? For example, you may have been focusing on retirement, but a wedding or a baby has changed your priorities. Next, think about your attitude for risk. Is it still the same, or has that too changed? With those 2 points in mind, find out how your funds have performed. This information can be established through your chosen investment platform. You'll be able to see whether the overall value of your investment has risen or fallen over different time periods. Consider the following questions. What has been contributed to the returns achieved? Has the fund risen almost by default because of stock markets have gone up, or has the manager succeeded where his rivals have failed? Investment houses usually publish monthly and quarterly updates on their funds, outlining their current positioning and factors that have influenced their performance. They will also provide a forward-looking assessment of how they see markets and what impact this is likely to have, either positively or negatively, on their portfolios. Then look at the asset allocation and geographical spread of your portfolio. Does it look about right? Do you think you need to adjust it? As such exposure can change over time, monitoring where your fund is invested means you can ensure the spread of assets is still suitable for you. Rebalance your portfolio if you think necessary and fill any gaps that you have discovered. This may sound like a lot of work at first, but the more exposure you have to these questions and rebalancing, the more likely it is to become second nature. While a detailed review should be carried out at least once a year, revisiting your choices every few months is advisable as it enables you to spot potential problems early. In addition, changes to your circumstances and goals should prompt a review to see how they are likely to affect your investment needs over the coming years.